Happy New Year and welcome back.
Are you happy though?
I am. My account value is only transitory.
Funny guy. Wednesday was beautiful until the Fed fucked it up with the December minutes.
Yup, to summarize, the Fed believes that the job market is nearing full employment, and most importantly, the inflation is high enough, so they've decided to raise rates and reduce asset purchases. Those two are pretty much expected, but they also announced that they are going to start reducing balance sheet soon.
Yeah, that third one really dropped the bomb on the stock market. Nobody was expecting the Fed to start talking about reducing balance sheet this early. And the board members believe that the balance sheet reduction should start closer to when rate hike is happening.
I'm wondering why the market did not expect this.
I think it's because during the last rate hike period, there was almost a 2-year gap between the rate hike started and reduced balance sheet started.
So, how will Fed reduce the balance sheet? Why is the market reacting this big?
Alright, so before we talk about how the Fed will reduce the balance sheet, we need to know that the Fed increased the liquidity and the balance sheet by buying the bonds from the market, which is quantitative easing since March of 2020. So the Fed has two ways to reduce balance sheet. First is to sell the bonds that the Fed is holding. Second is when these bonds mature, the Fed does not extend the bond's maturity period.
Got it. So basically, it is a more aggressive way to tighten the monetary policy than rate hikes. Since rate hikes can deter companies from borrowing money, but stop buying bonds and not extending the bond maturity period is essentially directly pulling liquidity from the market.
Exactly. So the market was expecting rate hikes to be sooner, but now since the balance sheet reduction is also starting soon, the market is shaken a bit.
Once liquidity is pulled from the market, the circulating US dollar will be worth more, and the assets value through USD will be cheaper. So there will be a lot of reevaluation. For example, something that is worth 1,000 USD might be worth 900 USD with the dollar being worth more.
Also, reducing liquidity is not only forcing re-evaluation, but it also means less gambling money in the market. This is also why we are seeing a lot of pullbacks happening with the tech and growth stocks.
Guys, also remember, according to market consensus, there is a 80% chance of rate hikes starting March. So earliest we're expecting for balance sheet reduction should be at least 6 months after the first rate hike.
Oh, toward the end of 2022 and beginning of 2023, so we are chilling for now.
Yeah, I don't think the Fed will start the reduction right when the rate hike starts. That's way too aggressive. I think the only way that happens is if inflation has gone bananas. If the next inflation data is over 7 and it keeps on marching up, then the Fed will have to do something about it.
Yep, when the market grew over 100% in the past 2 years, and if you look at the balance sheet, you will realize, oh shit, the balance sheet also doubled in the past 2 years. I wonder where all the money went.
Exactly. So when the Fed said, okay, we're pulling the money, you think the market can still be high in the sky? I doubt that. Anyway, let's move on and talk about a stock that we both are looking at.
Shares of Shopify are back in the buy the job situation. Shopify is currently trading 35% from its all-time high.
Well, I don't see any company-specific reason for their recent declines. I would say the big sell-offs were mainly caused by investors shifting away from highly priced growth stocks and leaning towards lower-priced value stocks.
What does it mean when these sell-offs don't have anything to do with the company's competitive positions, management team, or growth potential? Is it time to secure some shares?
Exactly. I don't even want to mention how much Shopify has grown since IPO back in May of 2015. 8,100%.
Yup, imagine turning $10,000 into $820,000 in 6 years. This is some crazy return. During the COVID years, Shopify rallied 185% and another 29% in 2021. When everyone thought the post-pandemic slowdown is going to negatively impact the company's performance. But nope.
You probably wonder why Shopify grows like weed. Just my opinion. I just think that Shopify is probably the best self-serve e-commerce platform that allows smaller businesses to quickly set up online stores without joining a crowded third-party marketplace such as Amazon or eBay, which nobody uses nowadays.
At the time of its IPO, Shopify only served 162,000 businesses globally. Today, it serves more than 1.7 million businesses. Shopify's revenue rose 86% in 2020 and grew 66% year over year in the first 9 months of 2021. Analysts expect its revenue to increase 56% for the full year and potentially rise 33% in 2022. Yes, the growth is decelerating, but this has a lot to do with the broader economy, like the global logistic congestion, supply chain issues, and of course, inflation.
Shopify has posted some impressive financial results over the past couple of years. Shopify splits its business into two main segments: subs, which is 30% of its revenue last quarter, and the other 70% of its revenue are from its payment processing, fulfillment, and financing services.
In the recent Shopify's management did not give a fourth quarter guidance. Applying the same Q3 growth rate of 45% with a full year revenue of $4.6 billion, let's make a quick assumption here. Shopify's lowest quarterly revenue growth as a public company was 45% since 2015. But we all understand that it will be difficult to grow at the same rate when the company gets larger. So let's be a little bit more generous for the next 5 years and 10 years.
If Shopify continues to average a growth rate of 35%, we're expecting the company's annual revenue to be around $13 billion in 2025 and nearly $52 billion in 2030.
That's right. We can't expect any company to sustain the same growth consistently. So this table demonstrates a couple of points. Even if Shopify's growth rate dropped down to roughly 20 to 25% for the next couple of years, we shouldn't be surprised to see Shopify join the $1 trillion market cap club before 2030.
Alright, just like Nvidia. But yep, this is a pretty simple valuation model. It serves its purpose to help us understand how the growth and valuation of a company can determine what a company's future market cap will be. And I'm sure we all know that valuations will rise and fall throughout the holding period, so investors must hold on to realize Shopify's potential. If they can, I believe Shopify can join the $1 trillion market cap by 2030. Personally, I opened a small position averaging $1,200 per share.
I'll bite. I opened a small position this week as well.
In the first trading week of 2022, we saw some notable rotation in the market. Growth sectors like tech and discretionary are not doing so hot, while most value sectors like energy is up 10% for the week and financials is also up 5%.
The 10-year Treasury yield went from 1.34% in early December to around 1.75% this week. This has put a lot of pressure on assets that are considered overvalued, basically majority of the tech stocks.
Yup, all eyes are still on the Fed. The yield jumped about 0.4 percentage points after the Fed minutes from December were released on Wednesday, and guess what? The market took a diarrhea.
Well, the market is pretty much reacting to what was released in the Fed meeting. Long story short, the Fed is pretty much saying they are going to speed up their tapering process and going to get it done sooner than most expected.
Keep in mind that these minutes were recorded back in mid-December, so many other factors like Omicron were not baked in completely. So the Fed might be less likely to do something aggressive due to rising virus pressures.
Aside from that, we have Friday's job report. Non-farm jobs only added 199,000 jobs, which fell short of expectation, which was around 400,000.
I believe this is still a viable pullback. Then again, we should keep our eyes on the Fed.
Thank you for watching. If you find this video helpful, feel free to give us a like and subscribe for more content like this.